don't know why I keep doing this every time I open a video, but we're back. Today's video we're going to be going over liquidity. Yeah, liquidity, how you can spot it in the market, how you can use liquidity to take trades as either exit points, not exit points, sorry, as take profit levels. Also how you can use it to, yeah, just take your trade. Basically just liquidity, how you can use liquidity to open trades, use them as target, take profits, and finding them on higher time frames and lower time frame liquidity and stuff like that as well. So market's moving right now, as you can see, but we're going to get on to the video. So I'll catch you in the next part, whenever the next part is, which will be fucking now. So first little bit is, what is liquidity? Is the main question. Liquidity is essentially money for the banks. Okay, it's orders for the banks. As you know, with a bank, okay, if they want to open their positions, they're playing with a lot of money. They're not the same as us retail traders. They're a lot bigger in the market. They're the people who actually move the market, and for them to open a position, they need to have spaces open. So back in the day, for example, when you're trading on Wall Street or something like that, you have to obviously fill your order. So you put in an order, and what you have to wait for somebody to obviously be selling that position so that you could compare basically the orders and be able to actually enter your position. Otherwise you could place an order, but you won't get filled in that order until somebody looks to sell it around that price as well. Nowadays, it's obviously you can do it with a click of a button. People are buying, people are selling constantly all the time. But for the banks to do it, they're doing it with massive orders. So they need to wipe people out, essentially. So they have to have that same type of orders. And as a retail trader, you look at the market like this and you see a big push down, a push up or whatever, and you go, oh, I want to place a trade here, for example, after the push down now, and I want to place my stop loss above these highs here and target these lows. That would have actually been a good trade. But for example, that's what you do. Okay, this is something you would do. If I can try and figure something as a bit more of an example, let's say here, you're like, I want to place my stop loss at these highs, okay, and my TP down, let's say down to these lows. You wouldn't have got hit just then, but you would have got stopped out. Market comes up, wipes out these highs, okay, where loads of people probably placed their stop loss, and then had a massive push down. Okay, so they filled their orders and then they did the big move. So that is essentially what liquidity is. So based off of what we've just gone over, in terms of banks, market makers needing to open positions or needing to take people out of their position so they can open their full position, you need to figure out where liquidity lies, which is the main thing. So we're on a daily time frame at the minute, which is a little bit more difficult to find liquidity. We're going to go to the 4-hourly time frame, which makes everything a little bit more sense. Okay, so liquidity lies at highs and lows, yeah, or just obvious places where you would think to place your position. This is why when we're talking in terms of trading, why patience is so key, because the market will do stuff on purpose to make people place positions, to wipe their positions out, to then fill their orders and then go in the direction you expect it to go. How many times, leave in the comments, how many times have you placed a trade, it's going your direction, it comes back up, it takes you out, and then it goes back down and hits your full TP after it's wiped you out because of where your stop loss was placed? It does it all the time, and that is what you need to look out for. You need to look at when you're placing your stop losses, and especially when you're placing your stop loss, you want to make sure liquidity is either being swept or is being swept before you place your position. Okay, so for example, places where liquidity lie at your highs and your lows. Okay, so we're going to start marking out some highs. So just to make it a little bit easier, I've put on the time frames of when the sessions are. So Asia session, New York session, and London session, or Asia, London, New York. Okay, just to give you a bit of an example of what happens is it price usually tends to take out the highs and lows of each session before moving in a certain direction. So if we can go to quite literally any session and kind of have a look. So just here, for example, as you can see, we have got here Asia session highs, Asia session lows, we've got London session lows, that's the wrong one, London session lows, London session highs, New York session highs, previous London session highs, and we've got New York session lows. Okay, we're just going to focus on this right now. Asian session played out, came down, we created Asia session low, London session low. So London obviously would have took Asia low already, that's fine. London session played out. What happened? We've gone into New York session, and as we've hit New York session, we've taken out London session highs, Asian session highs, and we've also taken out previous day London session highs. And then look at what we've done. We've come all the way down, all the way down, all the way down, all the way down, to all the way down to the bottom down here. So you could be looking for a trade, for example, after you've got this one. So after you've got New York session, whichever session you trade, which I'm assuming would be New York, because that's when the market's most volatile for this session, for this pair. But we've got a sweep of liquidity, break of structure, retest of a fair value gap, for example, and now price pushes all the way back down to London session lows again. So you could have placed a trade with inside this level, for example, if it was something like something like this, here, all the way down to either London session lows. Well, it would have been London session lows realistically, because you didn't have any New York session lows back then. So you would place it down to London session lows for 1 to 4, for example. Bang, and it would have hit just off of that. So that's one example. We can go over. We can try to go over some more examples as well. Let's have a look. So you might not have traded this day. There was nothing there. This day, there was definitely something. As you can see, it's pretty much the exact same setup. We've got what? Asian session highs, London session highs, Asian session lows, London session lows. Yeah. So we've come into London. Look at this massive candle. As soon as market opens, what happens? Market opens, sweeps London session highs, drops back down. You get a break of structure on a smaller time frame. Price probably come back up again into this level here, which is what? Once again, a fair value gap. As you can see just here, fair value gap. Sweep London highs, drop down, come back up into the fair value gap, respected the fair value gap, which then you could have placed a trade here because we respected the fair value gap. Bang. Targeted London session lows. Look what happened. Boom. All the way down to London session lows. Another 1 to 4 RR. You know? And this isn't even off of just out. This isn't even off of hourly session. Liquidity. This is just off previous. This is just off previous session liquidity. In the day, in the same day, on the 15-minute time frame. You know? Let me get rid of this stuff. Let's see, might not have taken a trade, might not have taken a trade. This is all getting extremely early, so let me go back to some previous stuff. Let's have a look here. Once again, as you can see, Asian session highs. We never took Asian, but what do we take? We basically took London session highs. Comes back down. New York session opens. What happens in New York session? Straight push up, bang, bang, bang. Push up, sweeps London session liquidity. All the people that would have placed their stop losses up here from this big push down, thought they're in profit. Bang, sweeps them out. Price, what does it do? Rejects, goes all the way down, takes out London session lows. Sweep of both. Bang, bang. New York session tends to do that quite often. Sweep of both. You even got one in the opposite direction here. London session. New York session opens, comes down, sweeps these lows. Sweep. Push back up, sweeps London session highs. You know? Obviously, some days there's going to be no trades, but most of the time, this happens. You just have to be able to catch it. You've got Asian session. Asia session for London. Look at that. Sweep Asia session lows. Then took Asia session highs for London. If you want to trade London session. Another quick reason as to why I've gone over sessions instead as liquidity, which I like more, because you obviously got the 3 sessions in the day. Obviously, you know, if you don't trade Sydney, I highly doubt people trade Sydney session. If you do, then good luck to you. But Asian, London, New York. Usually what happens is New York will take the London session either high or low and then sweep the opposite direction. You've also got to understand a few more things. You can't just trade off of liquidity. You have to understand market momentum, price action, and obviously the trend overall. But I prefer to take this type of trades off of the previous daily highs or lows. Okay, and sometimes hourly liquidity as well. So if you got an hourly high or an hourly low, which is a strong draw of liquidity, you can use that as well. The reason I've said it this way first is because you also use supply and demand. I mean, everybody knows supply and demand. This is one of the most common ways to trade as a beginner trader. You want to trade supply and demand, you go to the hourly, 4-hourly time frame, and you find supply and demand zones. Supply and demand zones are just areas where the market's bounced multiple times. People wait for a break of that level. So for example here, like this on a higher time frame makes a little bit more sense, but prices come up, bounce once, come down, bounce again, bounce, 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 bounce. This zone here clearly is hard for price to break above. People wait for a big bearish engulfing, something like this. They place their trade, they put their stop losses where? All put their stop losses here. Price comes down, this is on a higher time frame, price comes up, sweeps all of these liquidity, and then look what happens, bang, price pushes even further down. This is just the exact same thing, just on a higher time frame. If we look at this, look, we've got session high, session high, session high, session high, session high, session high. Do you mean we've taken it out? You know, it works the exact same. This is obviously over a longer period. So if you're really trading, you want to be looking at the hourly liquidity, 15, 5-minute, 1-minute entries. But it depends on if you want to, you know, it depends on if you want to take bigger, longer trades and hold it for longer. You can do that as well. But I've used it off of the sessions as liquidity for myself. So it's fairly straightforward liquidity. That's essentially how it works. I mean, just to recap and then go over a few more pointers with liquidity and how it works is, obviously banks want to open massive position, tens of millions of pounds. They can't open it at a certain price without taking people out first, otherwise their orders will not get filled. So what they also tend to do is they make the market consolidate. Okay, if you know anything about trading, you know what consolidation is. Consolidation is something like this. Okay, so this is consolidation, as you can see, Asia session consolidation. On a higher time frame, so price will consolidate between two zones. Okay, consolidate, sweep, liquidity. They've built orders, a bunch of orders here and here. People who are selling here, people who are buying here. Stop losses here, stop losses here. They're orders, bunch of orders. So now the market makers can sweep, fill their positions, go up and sweep and fill more of their positions to continue to push price in their desired direction. Okay, that is how liquidity works, and this was a consolidation information as well. So if you see the market consolidating, potentially expect a big move sooner or later. And yeah, this goes hand in hand with the trend of the market, whether we're bullish or bearish. Also goes hand in hand with price action, so how to actually enter. Usually you would want to wait for a liquidity sweep, and then you would look for your position to target the next draws in liquidity. But yeah, that's it for this video. Let me know what you guys think, especially let me know if there's any areas you would like me to touch over a little bit more. The next video will probably be bearish trend. Not just bearish, it'll just be trend in the market overall, so if we're bullish or if we're bearish, and then obviously just price action video as well, just to kind of show you how to enter positions after we've had a liquidity sweep and stuff like that. So leave a comment, leave a like on this video as well, it does help out, and I'll catch you lot in the next one. Peace.